the narrative of storing value is really Bitcoin's use case. Ethereum's use case is that it's actually going to be used. Wall Street now is going to be building its entire infrastructure onto the blockchain. And the blockchain they're choosing is Ethereum. So this is the 1971 moment where Wall Street is essentially capitalizing on tokenizing the entire world onto a blockchain. That's a huge opportunity. I'm not bearish on Bitcoin because I think Bitcoin will get to 1 million.
He argues that while Bitcoin has won the store of value narrative, Ethereum is experiencing its 1971 moment, a parallel to when the US dollar left the gold standard. In that historical event, gold became the hedge like Bitcoin is today, but the newly untethered synthetic dollar became the rails upon which Wall Street built its multi-trillion-dollar empire. Lee contends that Wall Street has now unequivocally chosen Ethereum, with its flawless track record of zero downtime, as the new synthetic rails to tokenize the entire real world, representing an opportunity he describes as orders of magnitude larger than gold.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
Ethereum differs from Bitcoin. Actually, Ethereum was initially a fork of Bitcoin, by the way, but with an added feature, which is smart contracts. So what they wanted to do on Ethereum was to say, let's use blockchain technology not just to store value, but now to store information. Ethereum is as a smart contract platform, actually also has something called the EVM, Ethereum Virtual Machine. So you can run entire programs and conditional contracts on Ethereum. And Ethereum itself is 100% reliable. It has not had a single moment of downtime since inception. It's one of the few blockchains that has never been down. And then if you needed to do more things on Ethereum, you can build what they call layer 2s on top of it. So Ethereum is essentially infrastructure that now is catching the attention of two industries. The first is the financial sector. The stablecoins became really a breakaway product for crypto, and that's like the ChatGPT moment. There's $250 billion worth of stablecoins. The vast majority of those are minted on Ethereum. Then the Genius Act was passed by this administration and this Congress, and that greenlighted the proliferation of stablecoins onto the blockchain. So banks are now building stablecoin products. That Treasury Secretary Bessent thinks that could get to 4 trillion. That's exponential growth, burning gas on Ethereum. And then we have Project Crypto, which is the SEC wanting Wall Street to build on the blockchain. Now, all of that collectively, from a Wall Street perspective, is like 1971 for the dollar. And what I mean by that is, in 1971, the dollar went off the gold standard. So in 1971, the dollar became synthetic. And gold was what people bought as a hedge against that synthetic dollar. So you had gold as the trade, and that would be the Bitcoin equivalent. But actually, the synthetic dollar is what created the rails for Wall Street to build all their future products. The futures, curves, derivatives were all because the dollar was a synthetic product. If the dollar was backed by gold, Wall Street would be still a very small business. Well, Wall Street now is going to be building its entire infrastructure onto the blockchain, and the blockchain they're choosing is Ethereum. So this is the 1971 moment where Wall Street is essentially capitalizing on tokenizing the entire world onto a blockchain. That's a huge opportunity. The second story arc benefiting Ethereum, though, is AI, because now we're moving towards an agentic AI world, but with real products. Like, AI is principally been trained on like internet and, social media, but it hasn't been in the real world because it hasn't ingested us as we moved and physically moved or even have independent products. That's a vast amount of new information for AI models to ingest and store. But then now you have to be sure that all the instructions being sent back to the robot are proof of the originator. In other words, you need a token. I mean, LLMs use tokens anyways, but now you need like a token that interacts across chains. And that's where AI is going to build on Ethereum, because you essentially need what they call proof of human. We need to prove that this lawnmower got a real instruction from another chain or another vendor. And so that is all being built on Ethereum. Before this year, I would have considered Ethereum like a really good, reliable chain, but without any products being built on it, it shouldn't really do well. But because of what's happening with AI and with Wall Street and, Project Crypto, I think Ethereum's essentially the value of its protocol layer, like, Union Square Ventures calls it the FAT protocol, is now going to be more valuable because we're tokenizing everything on Ethereum rather than just gold. Like, so if gold is a $21 trillion market, tokenizing the real world is orders of magnitude larger than gold, which means Ethereum probably will flip in network value versus Bitcoin.
Flip as in outgrow it?
Yeah, it'll have a higher network value. I think that the distinction to make is that I'm not bearish on Bitcoin because I think Bitcoin will get to 1 million.
But what about all the other cryptocurrencies?
Well, other cryptocurrencies don't have the network value because otherwise they're just software chains, meaning...
So you don't really believe in Ethereum as a currency. You believe in it for other reasons.
That's right. Yeah, I think that the narrative of storing value is really Bitcoin's use case. Ethereum's use case is that it's actually going to be used and burned. So Ethereum gets consumed through gas fees, and then staking is how you produce an Ethereum. That inflation rate has been below Bitcoin, actually. So if you look at it as monetary supply, Bitcoin's monetary supply is actually still growing faster than Ethereum.
The core of Lee's explosive thesis rests on two colossal converging catalysts. The first is the institutional adoption driven by stablecoins, which he calls the ChatGPT moment for crypto. With regulatory clarity from the Genius Act, Wall Street is no longer experimenting. It is actively building its entire future infrastructure on Ethereum. The second equally powerful catalyst is the rise of agentic AI. As AI moves from the digital to the physical world, it requires a secure, verifiable system for real-world instructions, what Lee calls proof of human. This requires a token-based protocol, and he asserts that the AI industry is building this critical infrastructure on Ethereum. These are not future hypotheticals, they are massive capital and development flows happening right now.
Tether created the first dollar stablecoin, and they built it on Ethereum. Their idea was someone doesn't always want to be long Bitcoin or another crypto. They want to be long something stable. And crypto holders weren't really allowed banking access. So they didn't have an off-ramp. So Tether built a dollar-backed coin called a stablecoin, USDT. Mm-hmm. In 2017, Google and the UT Austin wrote these papers claiming Tether was just a fraud. And the only reason crypto went up was because of Tether creations. Okay, so in other words, it was immediately tried to be viewed as something fake. But then Tether has since grown, and of course stablecoins have really grown in popularity. Merchants outside the US love stablecoins because they don't suffer the chargebacks. Credit card companies merchants eat fraudulent transactions. So merchants, they get paid, it's just as good as getting $1. In Turkey and a place like India, Tether trades at a premium to the dollar because people prefer to get that over cash because it's hard to get robbed. You can use a stable coin to buy real estate in Dubai now using Tether, like $100 million transactions. So it's actually being used in the real world. Actually, stablecoin usage, 80% is outside the US. But the reason the US administration starts to like it is, number one, crypto is essentially 100% quoted in dollars. In GDP terms, the dollar is 27% of global economy. It's 55% of central bank reserves is the dollar. It's 80% of traditional financial market pair quotes. So the synthetic dollar, which happened in 1971, made the dollar 80% dominant. In the crypto world, the dollar is 100% dominant. So the U.S. wants us to financialize into crypto because everybody prefers to get $1. Collectively, the stablecoin industry is about $280 billion of outstanding dollars. They are now the 12th largest holder of treasuries in the world. Japan owns $1.2 trillion of treasuries. Treasury Secretary Bessent thinks this market will get to 4 trillion. That would make stablecoins the largest holder of treasuries in the world. So it'll be backstopping the entire treasury market soon. Well, the Granny Shots ETF, and it's called Granny Shots. It's named after a way of shooting a free throw in basketball, underhanded. And the idea is that an underhanded free throw has a higher probability of being a successful shot because it's the best physics move, but it doesn't look cool. And so our research launched the Granny Shots portfolio in 2019 as our best ideas list. The way it was constructed is we said that the S&P is essentially driven by a handful of companies tied to the most important themes. And at that time, we identified the themes as AI, labor shortage, cybersecurity, monetary policy tilting, ISM tilting, millennials, things that we know are actually logical. And we said in order for a stock to be included in that list, it had to be tied to 2 themes because we figured 2 sales means that you can catch the wind from 2 different directions, you know? And it worked really well. That's for 6 consecutive years it outperformed the market. So we decided to launch it as an ETF last November to make it available to the public.
And what's the performance been since November? It's shortish term, but...
Year to date, Granny Shots is up over around 18%. So it's outperformed the S&P, which is up around 9. Morningstar ranks it as top 2 percentile. So it's out of the 1,490 large cap active equity funds, we're top 30. It's rebalanced every 3 months. One thing to keep in mind is that it owns 30 stocks. So it's really the 30 biggest sort of drivers of the S&P, but it's equal weighted. So it's not benefiting from just owning the Mag 7. In fact, year to date, it's outperforming even the Momentum Index, MTUM, Granny Shots. And it has a lot of financials in it and it has some healthcare. So it's really a diversified fund, but I think it should be viewed as we've identified the companies that are really driving the S&P, so the other 470 aren't driving earnings for the S&P or the price appreciation.
These dual catalysts lead directly to Lee's most stunning conclusion. Ethereum will likely flip Bitcoin in total network value. This is not a bearish call on Bitcoin, which he still believes is heading to $1 million. It is a profound relative value argument. Bitcoin's use case is to store value, but Ethereum's use case is utility. It is the base layer being actively used and consumed by the 2 largest technological and financial shifts of our lifetime. As the entire world is tokenized on its rails, the value accrual to Ethereum's FAT protocol will be immense. This positions Ethereum not as a competitor to Bitcoin's money narrative, but as a fundamentally different and potentially far larger investment thesis.